small business assets exclusion is definitely something which I think doesn't get as much attention as it should, because it's definitely a fantastic exclusion which is available to us. All right. Now, please bear in mind that I am not going to be able to discuss every last nuance and minutia of this particular exclusion, just because it does actually start getting quite tricky, or no, not tricky, but it starts getting quite involved and intricate, and it kind of would mean that I'd have to spend the whole of the session on it. But what I can just say straight off the bat is, if you are interested in reading up on this in more detail, I have put the link into the notes as well, but please go have a look at the SARS website, have a look at types of tax, go to CGT, and then pick up the comprehensive guide to capital gains tax. Now, this document honestly is my go-to. And yes, I know it's scary. It says 966 pages, but that's part of the reason why it's so good, is because it's got the detail on literally everything that you could want. It's the discussions on capital versus revenue. They've got discussions on capital, on case law, in terms of what do we mean by income earning structure versus income earning operations. It tells you what do we mean by base cost, how do we do calculations, what are some of the benefits, and what do we mean by proceeds, and all the rest. So that's that. But then, very relevant to our purposes, is that we would be looking at section 50, exclusion para 57, and para 57 there is the disposal of small business assets on retirement. And as you can see, there's quite a lot of detail in here in terms of how do these varying provisions work. There's worked examples, and it's, close on 5 pages worth of examples. So this is definitely, if you're needing more detail, this is the place to go to, right? The Contiki tour of how para 57 works is as follows. All right. The core requirements are, in order to apply, or in order to qualify for para 57, you need to have active business assets. Now, active business assets are defined as assets used exclusively for trade purposes. If you're looking at immovable property, we are looking at only to the extent that it's used for trade. So if, for example, you look at me, I'm now sole prop. I run a consulting and training business. I use the granny flat on my property to run my business. So when I'm looking at the assets that would qualify, it would only be the portion of my property which is used for trade, which would qualify for this exclusion. The rest of the property would not. You could have, for example, a commercial property where you use half for trade purposes and the other half is used for, I don't know, something else. Maybe you let a friend use it or something. Right. It specifically excludes financial instruments and assets held mainly to derive investment income. So in other words, when they're looking at what they want to apply the exclusion to, is they are looking at the assets that are actually actively being used for trade. There must be an actual operation in there. And for the purposes of this exclusion, no, an investment business does not count as a trade. Right? It won't count in. It won't count for the purposes of the section. So you have to actually be actively trading with them. So running a little retail business, running a consulting business, running a literally anything, right? Unfortunately, if you go and have a look at rental properties, now rental properties are actually also specifically excluded. Okay. So that's not going to be something which they're going to allow. So actually rental is specifically excluded. For the purposes of the slides, I've shortened it to investment income. But if you actually go and have a look at para 57, it specifies interest, dividends, rental income, and I think there's 1 or 2 other annuity income. So basically your standard passive stuff is scoped out. What else? If you're a sole prop, well, then obviously you qualify. If you are a member of a CC or you're a shareholder in a PTY Limited, then in order to qualify for the Para 57, you have to hold at least 10% of the shares of the company. Right. Please bear in mind that for tax purposes, remember, 10% members' interest or 10% shareholding in a PTY Limited, both are viewed as a 10% shareholding, right? And you have to have held that for at least 5 years. And I find this is unfortunately sometimes where a lot of people trip up, is because they don't meet the 5-year criteria, either because they've just started the business and are now looking at selling it, or because they've changed the format of the business and, it used to be a sole prop, is now a company, or, they've done a Section 42 or a restructure, which means that they haven't held those shares for 5 years, which is quite a big problem, right? So criteria 1 only applies to active business assets. You have to have at least a 10% shareholding if you're a CC or a PTY. And then last but not least, you have to be selling or you have to be opting out of this business, either due to ill health or being over 55. So if I go back to the example or the question, is in the question, our individual was over 55. So from that point of view, we qualify. Trademarks and royalties agreements. Now, trademarks would very much qualify as an asset, and if you're actually getting royalty off them, they would definitely qualify for the definition of an active business asset. What we always then need to go back and double check, intangible assets are listed as are obviously an intangible asset, but they are not necessarily a financial instrument, because remember, a financial instrument is generally where we would be a financial instrument is defined in Section 1.1. Sorry, apologies. I thought I had this one ready and I misflagged it. So financial instrument is a loan, advance, debt, bond, debenture, also that's not it. A repurchase or resale agreement, that's not it. A contractual right, which is linked to debt, security, or equity, not it. Interest-bearing arrangements, definitely not it. Any financial arrangement based with reference to time value of money or cash flow, definitely not it. And lastly, any crypto assets. So your IP and the royalty agreements would definitely qualify as being active, as active business assets, right? So from that point of view, so far, so good, right? This is unfortunately, however, not where it ends, because in addition, you have to recognize the full capital gain within 24 months of the date of first disposal. So if you are selling your operations piecemeal, you can't sell a portion now and a portion in 6 months, in a year's time, and then another portion in 3 years' time. You can't have to do a wholesale sale, right? Secondly, is there's no restriction which says that you can only apply this to one and not to multiple businesses, right? However, there is a cap which says the small business exclusion is only available if the market value of your total business is less than 10 million rand. So if you are involved in multiple businesses, that 10 million is then measured across all your businesses, not per business. Okay. It is, or realistically, we therefore need to look at your stake, how long you've held it, how many businesses you own, and the 10 million criteria. And then last but not least is the reminder that this 1.8 million is a lifetime amount. It's not a per business amount. Right. So you are going, I find a lot of people fall outside of Para 57 because they have stakes in multiple businesses, or they don't have big enough stakes in those businesses. Because if you're a 10% shareholder in a company and that company is worth 20 million, sure, my 10% stake is way below the 10 million. But when I'm measuring my 10 million stake here for the purposes of Para 57, I don't look at what my shares are worth. I look at what the total business I've invested in is worth. We can argue that that's unfair. We can argue that that's a stupid piece of law. It is what it is, right? And also, you have to measure all your businesses together, right? It does mean that for a lot of taxpayers, if they are your true entrepreneur, then they would generally have multiple businesses, and it may mean that you're only going to be able to claim this exclusion once you've actually sold a couple, because at that point you drop below the 10 million. Please, also, as I said, it's a lifetime 1.8. So if I've used that 1.8 today, so going back to our example, so if I sell my royalties and my trademarks and I claim the 1.8 today, I cannot use it again. It's gone. Disappeared. And I think that's not always abundantly clear to people who look at the exclusion, because they're used to things like our primary residence exclusion, which attaches per property, not for a lifetime, or like our interest exemptions, or our annual exclusions, which renew. So lifetime on this one. As I say, there's more extensive examples in here, which you can go and have a look at. So I will take, though, I've seen there's a few questions which have come through on the chat box. The first question is, so if I have a medical practitioner who is below the 10 million and would therefore would qualify, and he's over 55, and he chooses to incorporate his practice. So he is a sole prop and he chooses to sell it to an Inc. instead. Could he use Section 57? All right. Then yes, you can claim it. There's nothing that says that if it's sold to a connected person that you can't, right? The only thing that I would say in that space, in the case of a sole prop with an Inc., is it may be worth thinking about why you would do that. It may be easier to actually just rather use Section 42, so your asset for share transactions, to actually create the Inc. Unless you're basically creating the Inc. to then go and sell, in which case then sure, then it may make more sense. But that's not your only option, because once you sell the Inc. in 5 years' time, you then can claim the 1.8 on the sale of the shares. And you'd actually have a higher base cost due to the Section 42. Just a thought. Second question, if I have, say, 4 businesses and sell one this year, but only use R1 million of the exclusion, does the 800,000 carry forward when I sell the other one? Absolutely. So as I say, the 1.8 is for a lifetime, and you can use that 1.8 in one transaction or 17, it doesn't matter. But if you use it all up in your first transaction, then you don't ever get to use it again. Okay. Right. So there's another question. If a taxpayer dies and has a cottage on his primary residence that he rents out, does the deemed capital gain on the cottage fall under this exemption? Absolutely not, because remember, in my definition of active business assets, I've specifically excluded any assets which generate rental income. Okay, so unfortunately, it's not available for rental property, right? If you are over 50, no. The next question is, if you're over 55, do you not have to retire to claim the 1.8? No, you simply have to be over 55. So you could also be getting the exact wording that they use is blah, 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 blah. You must be substantially, and that's the other thing. You have to have an active involvement in the business, because the wording in the legislation is, and you were substantially involved in the operations of the business of that small business during that period, and you have attained the age of 55 years, or the disposal is in consequence of ill health, other infirmity, superannuation, or death. Right. So the 55 is literally the benchmark. And I think part of that is that there's a lot of us who will recognize, and it's kind of become a financial planning reality. Once we get over 55, we have to change what we do, but most of us are not going to be able to afford to fully retire at 55 either. But you probably don't want to be doing a job which requires you to still be lifting heavy stuff and out in the hot sun the whole day, every day. So it's, as long as you're over 55, the law doesn't look at the law doesn't look at it from any other perspective. All right. I'm going to take a last question on this, because otherwise we definitely are not getting through the rest of the stuff. What happens if you sell a farm and the buyer pays the amount in yearly amounts? Would you be taxed on the full amount for which the farm was sold, or when you receive the installments? All right. Now, that question, thank you for that one, is actually quite relevant to this criteria here. And it goes back to, and again, it's covered in a lot of detail in the comprehensive guide. Per the 8th schedule, so per para 2 of the 8th schedule, you have to recognize a capital gain or loss on the disposal of an asset. Under para 13, the timing of that disposal is generally in the sale of a farm, it is based on when the contract, it's the earlier of when the asset is actually physically disposed of, in other words, when transfer happens, or when the agreement is concluded. So in 99% of the cases, it's going to be when the agreement is concluded. Right. So if you're selling your farm and the sale is, hi, I've sold you my farm, you will pay me R1 million every year for the next 15 years. Okay, I'm pulling numbers out of thin air. Maybe 10 million for the next 15 years, depending on the farm. But the point remains, you've sold everything today with a payment plan. Now, my contract was concluded on date of signature, and the amount has accrued to me. So under the CGT rules, the full capital gain is payable on the date the signature is signed. The date the contract is signed. The day your signature goes on there. The absolute only way that you can change that timing rule under para 13 is if you can apply para 39 cap A, which talks about disposals for unquantified amounts of proceeds. Unquantified amounts of proceeds would be, for example, if I sell the farm for 10 million upfront and 5% of profits for the next 15 years. Now, in that case, well, I sure as heck don't know what the profits are going to be this year, next year, or the next in the next 15 years. So I obviously can't recognize the capital gain. So you would have to recognize the capital gain on an annual basis. However, if you sign that agreement, remember, then you will definitely not qualify for para 57, because para 57 requires you to have recognized all the capital gain relative or responsible for, or to be triggered from that transaction within 24 months. So it wouldn't qualify. Okay. So we need to be a little bit careful with that one. All right, I'm going to leave that there. I see there's been a few other questions which have come up on CGT. I'm going to park those for the moment, just so that I can guarantee that we can cover the content, because that's also the other point that I wanted to make. That's also just another admin thing. Sorry, I did not mention this up front. If you want to guarantee that I get to your question, because an hour and a half is not that long actually when you start getting into it, please email the questions when the mailer goes out. because then I absolutely will have brought your question into the slides. Either your question or one of dealing with a similar theme. It will come into the question. If you ask your question during the session, I'll try to get to it, but I can't make promises. Okay. What we do also do, though, is that at the end of the sessions, the tax faculty team sends me a copy of the chat, and I try and do a quick written response to all of the comments. So even if I don't get to it, we make no promises as to when those are published, but we do try and get to the Q&A in the chat as well, or at least have a response to it. Okay, so we do not forget you, but to guarantee an answer, send through an email. Okay. Right. Unfortunately, there are a few perennial favorites. No, favorites is the wrong word. Bugbears, which are almost eternal, and I wish I could make wish I could make these all go away with you. Right. If